Over the past few days, something unusual has been showing up in global shipping data. Not a breaking headline, not a crisis alert, just small irregularities, the kind markets usually notice quietly. Oil tankers linked to Venezuela have been moving with their tracking systems switched off. No AIS signal, no live position. From the data's point of view, they simply drop out of sight. This practice is known as going dark. In global shipping, it's not routine behavior. It usually appears when pressure starts building, legal, financial, or political. Venezuela is still a significant oil exporter operating under sanctions, routing constraints, and fragile counterparty trust. That system functions only when visibility exists, when insurers can price risk, ports can approve movement, and trades can be cleared without hesitation. When visibility is reduced, markets don't debate motives, they adjust assumptions. And once assumptions start changing, the effect doesn't stay limited to oil. Shipping is the connective tissue of commodities. Energy, metals, agriculture all move through the same logistical and financial pipes. As those pipes become less transparent, institutions begin adjusting exposure across the system, not country by country, not headline by headline, but through risk models and hedges. That's when certain markets start behaving differently, not because supply has changed, not because demand has shifted, but because uncertainty is entering the system. And in those moments, attention quietly drifts toward assets that tend to reflect system stress early, especially ones that sit between industry and finance, between physical trade and monetary behavior. Because shipping is not just about moving barrels or containers, it's about trust. Every global trade assumes three things work smoothly in the background: routes, insurance, and settlement. When all three are visible, markets stay relaxed. When even one becomes unclear, pricing starts to change. Shipping routes are shared infrastructure. Oil, metals, agricultural goods, they all rely on the same ports, the same insurers, the same trade finance channels. So when opacity appears in one lane, risk managers don't isolate it. They widen the lens. This is where people misunderstand what markets do next. They don't assume shortages everywhere. They don't panic buy commodities. Instead, they quietly add a risk premium. Insurance costs edge higher. Freight terms get adjusted. Financing becomes slightly more cautious. Nothing dramatic, just enough friction to be noticed by institutions, not headlines. That friction spreads perception, not fear. And perception is enough to shift positioning. Because once shipping reliability comes into question, even temporarily, it affects how confidently future deliveries are priced. Across energy, across metals, across anything that depends on physical movement. This is why shipping news often travels faster through trading desks than through newsrooms. By the time the public notices, models have already been updated. And as those models start accounting for higher system uncertainty, the reaction doesn't stay confined to logistics or oil alone. It begins showing up in how commodities are hedged, how volatility is priced, and where capital starts watching more closely. Because silver sits in an uncomfortable place in the system. Not fully a safe haven, not just an industrial metal. It's both, and that makes it sensitive. Silver moves through the same ships, the same ports, the same financing channels as industrial commodities, but it's priced and hedged like money. So when logistical confidence starts slipping, silver feels it from both sides at once. This is why silver rarely waits for confirmation. It doesn't need a declared crisis. It doesn't wait for sanctions to be announced or routes to be closed. It reacts to hesitation. When insurers hesitate, when freight contracts hesitate, when trade desks hesitate to roll exposure forward at the same terms. Those pauses don't show up in headlines. They show up in spreads, in lease rates, in positioning. And silver is unusually responsive to that. Because silver supply is physical, bulky, and location dependent, and silver demand is global, leveraged, and sensitive to confidence. So when the system starts feeling tight, not broken, just tense, silver often moves in ways that don't immediately make sense to casual observers. It starts drifting, sometimes sharply, sometimes before any visible trigger exists. That's when people say silver is overreacting. But from inside the system, it's not reacting at all. It's repricing the environment before the environment admits it has changed. This pattern isn't new. Markets have seen it before. Whenever global logistics start showing stress, not collapse, just friction, silver tends to move early, fast, and often uncomfortably. You saw it during the late 2000s when shipping finance tightened before the financial system openly broke. Silver didn't wait for bank failures to be confirmed. It started repricing uncertainty while headlines were still calm. You saw it again around the early 2010s, when sovereign risk, trade flows, and commodity financing all became unstable at the same time. Silver didn't move smoothly. It surged, snapped back, then surged again, confusing anyone looking only at industrial demand. And more recently, during global disruptions when ports slowed, freight costs exploded, and delivery timelines stopped being reliable, silver didn't behave like a simple metal. It became volatile, aggressively so, What's important isn't the exact price, it's the speed. Silver tends to compress movement into short windows, long periods of quiet, followed by sudden repricing, not gradual, not polite. That's why these phases feel urgent to professionals. Because once silver starts moving decisively, the system usually isn't at the beginning anymore. It's somewhere in the middle. And the uncomfortable part is that by the time silver's behavior becomes obvious to everyone, the underlying stress has already been present for a while, hidden in logistics data, insurance terms, shipping behavior, and risk models, which makes the timing feel different this time. Not dramatic, not chaotic, just early enough to matter, because what's unsettling isn't that something has already broken. It's that nothing looks broken yet. Oil is still moving, ports are still operating, markets are still functioning. But beneath that surface, behavior is changing. Ships don't go dark without a reason. Insurers don't quietly tighten terms without a signal. And silver doesn't start acting restless without pressure building somewhere upstream. None of this requires a headline. It doesn't need confirmation. It only needs enough participants to feel that assumptions are no longer solid. That's when positioning changes first. Language changes later. The system doesn't announce stress. It leaks it through logistics, through pricing behavior, through metals that sit uncomfortably between industry and money. And once those leaks start appearing at the same time, markets don't stop and wait to understand them. They move while explanations are still being written, which means the most important part of this story isn't what happens next. It's what's already happening quietly, without urgency in the news, without panic in prices, without a clear label anyone can point to yet.